Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And guys, the holidays are upon us. It is October 28th, so Halloween's just around the corner. Then we have Thanksgiving. Then we have Christmas. Then we have the New Year. So I thought, why don't we talk about trading during the holidays? And specifically, we're going to be talking about one or two tools that might assist a trader in the navigation of those holidays, at least from a historical perspective. So I think this is going to be an interesting discussion. I'll lay out a more precise agenda for what we're going to be doing today in just a moment. But let me first of all say hello to everybody who's chatting in out there in YouTube. Always see those familiar names. Great to see Eva and PR451, Austin, C. Larson, Ricebird, Frank, Paul, Richard, Life in the Fast Lane, and on that list goes. Thanks for joining us, guys. We really do appreciate your attendance and your contributions in each of these webcasts. If you happen to be here for the very first time, well, welcome to you. And if you're watching on the YouTube archive after the fact, enjoy the recording. It's a great way to watch our webcasts, but also be aware that you're invited to join us in the live stream if you'd like to be here. This is a Tuesday webcast series, and this one kicks off promptly at noon Eastern time. We would love to have you here in our live stream audience. Now, I also want to let our live stream audience members know that my very good friend Kevin Horner is going to be hanging out in the chats with us. He's going to be keeping an eye on your chat questions, and if I can't get to them, Kevin's going to pick up my slack. Thanks for having my back there, Kevin. Kevin and I would also like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite presenters from Schwab on X. It's a great place to connect with us in between these live streams. You can find Kevin there at Kevin Horner CS. You can find me there at Cameron May CS. If you reply to one of my posts, I try to reply right back to you. I also want to let you know that starting just very recently, just in the last couple of weeks, you can also connect with me on LinkedIn. Just look for me, Cameron May. Look for my little profile. You'll see me sitting on a bench with a let's say a Scottish castle in the background. Yes, it is a Scottish castle. But yeah, connect with me there on LinkedIn if you don't have an X account, or if you prefer the other platform, or maybe just follow me on both. I'm going to be doing different things on each of those platforms. So that should do that with the sort of pleasantries. But let's get into some serious stuff, which is, let's talk about risk for just a moment. These are important disclosures. Risk is real when trading and investing, so bear this information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay. So here's what we're going to be talking about today. We got the holidays just around the corner. So I wanted to go through a couple of chart tools that might assist a trader as they're attempting to navigate the holidays. We're going to be taking a look at what has typically happened in the holiday period over the last 20 years, and talk about how a trader might apply that to 2025. Now, obviously, 2025 is its own unique time frame. Nothing here is a guarantee of what's going to happen between now and the end of the year, but I think it should be an interesting discussion. So we're going to use those chart tools. We're going to be planning and placing an example long call trade, and included in that, we'll have example entries and exits. All right. So let's go right to the Thinkorswim desktop trading software platform, and let's have a look at what's going on with the S&P 500. We're sitting pretty much at break even from yesterday's all-time high close. Seems that we've had some productive negotiations on the trade front between the U.S. and China, and the markets appear to have reacted to that positively. Started off with a little additional strength a couple of hours ago. We've kind of been fading for the moment, but still actually slightly positive, still sitting up there. All-time highs reached again today. And so today I thought, you know what, let's continue what we've been doing for a long time in these webcasts. We're going to be planning and placing an example bullish trade, but I wanted to do that within the context of not just what's happened this year, but what's happened on average at this time of year over the last 20 years. So some of you already know what I'm referencing here. What is that? How can we check to see what, and I'm going to be using the S&P as sort of the stand-in for stocks, but we could use other market indices if we like. But what tool can we quickly switch to here on our charts to check to see how the markets have done on average around this time of year over the last 20 years? We're going to be using the seasonality chart. So right now we have just a typical, what we call a candlestick style of chart. And I'm going to switch that style. Right now you'll see it's just a standard chart. We're going to switch this to seasonality. Now this one you do have to know how to manipulate it a little bit to really pull the most out of it. So I'm going to load up that seasonality chart. And if you're not familiar with this, initially it consists of these two lines. It has a green line up here, which is still just the S&P 500. We're still on a one-year daily chart. So this is showing us how the S&P has done since January, since the first trading day of January. So we got off to a strong start. First part of the year, we had that sell-off as we started to move into springtime. And then this huge extended rally that we've had that's carried us right up to the present day. So all of this should be familiar data. Now, if we want to put that in longer term context, though, this is where we might want to look down at this red line. By default, the red line is just showing us what happened last year from the 1st of January to the end of December. That could be interesting if we wanted to do a comparison, but a couple of observations there. First of all, that's a very limited data set. And second of all, you can see this chart is very compressed down at the bottom. So I'm going to show a potential solution to both of those issues. Number one, let's get more data, not just what happened during the holidays last year, but what's happened during the holidays on average over the last 20 years. So I need to change my time frame. I'm going to come up here to where it says daily and switch our time frame. Let's go to a 20-year. I'm actually going to keep the time frame on a daily chart, 20-year daily chart, and click OK. And so that's going to load up what's happened on average. Well, actually, I already did that before the webcast launched. And so kind of a little bit of a cheat. That's okay. In any case, that's why you didn't see much of a change down here, because I'd already done this in preparation for the webcast. Anyway, to do that at home, that's what you would do. Now, a second thing that we might need to do is let's zoom in on this historical data down at the bottom. So it's not just one kind of very thin, not terribly useful flat line. And to do that, we're going to change the vertical aspect of the chart. Right now, it's just automatically determining the height of the chart. I'm going to change that to manual, which is going to allow us to come down here to the bottom and zoom. I'm going to click at the top, or click just above that 20-year time frame, and zoom down to the bottom, and you'll notice that's now highlighting just that chart. We're going to take that slice of this whole chart and just zoom in on it. It's going to blow that up to full screen size. And now I can see what the S&P has actually done, not last year, but again, over on average over the last 20 years. So this is interesting. If we look at, we talked about this tool a few months ago, and we talked about how there was this tendency from mid-September into the middle of October for the S&P to slide. We didn't get much of that this year. There we go. There was a little bit of a slide within this time frame. But look where we find ourselves right now. Again, as of this moment, it's October 28th. So maybe the trader might want to look at, well, let's find October 28th. That's right here. Interesting. And what happens as we move through Halloween, maybe toward Thanksgiving? Well, here's the 28th. And as we move toward Thanksgiving, Thanksgiving would be out here, right about there. And there's a bit of a flat part in the chart there. But really, that last week of October and the first couple of weeks of November historically have been pretty strong. So if we have the tendency to kind of shy away from the markets, oh no, it's a scary time of year, got lots of skeletons and goblins out in people's yards, maybe traders are also intimidated. Nope. No, actually, starting about now, on average, there's been a substantial run up over the next couple of weeks. Now, is this going to be exactly? Now, JDLMI says, is this a script to compare to year? or is it a tool you can get from the chart? So JDLMI, I actually demonstrated this as a tool. It's known as the seasonality chart, and I showed how to load it. Now, if you missed that, I can never fault somebody. I don't know what's going on in people's lives. We all have our own lives. So if you happen to miss that first few minutes, nice thing about these webcasts is that they are recorded, and the vast majority of those are then posted to our YouTube channel. So let me show you this. If for any reason you need to go back and revisit a webcast, here's what you'll want to do. First of all, make sure that you have subscribed to our Trader Talks channel on YouTube. So the full name of our YouTube channel is Trader Talks Schwab Coaching Webcasts. Go down below the live stream right now and just click on subscribe. But this is where you can join our live streams, but also you can find the playlists for these different webcast series right here. So if I click on playlists, this one's known as Getting Started with Options. It happens to be more toward the bottom of all of our playlists. So I'm going to scroll on all the way down to the bottom. I'm looking for Barb because she actually covered for one of my webcasts recently. So her face is on that series thumbnail. But there's Getting Started with Options, and I can click on View Full Playlist. And so shortly after this webcast is concluded, as long as we don't have some sort of unforeseen technical glitch, this webcast will be, the recording of this webcast will be posted right up here at the top. All right. Jay Weezy says, how do I get this view in Thinkorswim? I can only make an interval of 15-year, 1 month. So Jay Weezy, what you may not have caught is when I switch the time frame, instead of just going with the favorites here, we'll go to time frame here, make sure that we're on daily, and then go to time interval 20 years day. You can also go to custom there, but I'm just going to go to daily and use these two. Time interval is the length of the chart. Aggregation period is the length of the candle. So 20-year chart with daily candles. All right, there we go. So this is interesting. So as we move through Halloween, tends to be a pretty bullish time of year. Then maybe people just get ready. They have other priorities. Maybe as they're gearing up for the next holiday. Not much tends to happen in that week leading up to and through Thanksgiving. But then once the turkey wears off, what do they call it? Tryptophan? What is it? I don't want to throw out a word here. What's the stuff that makes you fall asleep that's in turkey? Anyway, once that wears off, what happens is we move toward Christmas. Well, up until maybe a week and a half or so, we historically have seen a tendency for markets to rise. So with this as sort of a backdrop, what sort of implications might this have for a trader who's maybe going to do something leveraged, something that's very time sensitive, like buying a long call? Was it tryptophan? I'm glad I pulled that out of my head. I don't know where that came from, because you only use that word once a year when you want to sound smart about talking about Thanksgiving dinner. Anyway, finally, around Christmas, it gets a little choppy. Right after Christmas, a nice run up into the new year. And you can see that does tend to continue into the next year. Football games, Ricebird? Yeah, absolutely. Some of you know that I'm a huge college football fan. Yeah. Anyway, I think that it's interesting to get this historical perspective. Again, it's not always a guarantee, but if a trader is making an effort, if they're working hard to just try to move the needle, maybe this is another tool that might provide some insight. All right. But let's now go look at maybe another tool. This is very broad. This is what's going on with the markets historically. How about, and Paul, you're asking a good question. I'm not going to go into commodities in this discussion. My apologies. But I do want to talk about what's going on with maybe different sectors. Get some recent historical context there. Why don't you chat in for me of the 11 different sectors that make up the S&P 500? There are really only a few that have been dragging the appearance of everyone else along. It can seem like, boy, the markets are just rocketing up and everybody's making money. It's not true. There are major portions of major arenas or areas of the marketplace that aren't making much money. So how do we see that? Let's just switch this back. That was fun to look at this historical context, but let's go back to our normal chart. So to switch the style, we go back to style. Our chart mode, we want to go back to standard. And then you just choose your preferred time frame here. I'm going to stay with the 1-year daily chart. All right. Eva says real estate. Kevin saying tech. Let's go have a look. If you don't know which sectors are doing well and which are doing poorly, for some traders, that's an important thing to check before going and placing a trade. Now, not everybody does. I haven't even decided if I want to include it in the stock that I choose for today. But how do we check the performance of the 11 different sectors? Well, Thinkorswim maintains and publishes a watch list of those sectors. So if we go to our watch list in the left column, I have the S&P 500, the 500 companies that comprise, or the 500-ish companies that comprise the S&P 500. I'm going to switch that instead to the public watch list of what Thinkorswim calls the sector indices, S&P 500 sector indices. And as I do that, you'll notice here, now we have 11 weird-looking symbols. Well, those symbols are actually the different sectors. And if I click on them, it will load those sectors I suppose I should show this, if I have linked the chart and my watch list. So you can just, if this is unlinked, just link it with choosing the same color right up here. Color or number. Anyway, so if I click on this first chart, this loads up a sector, but I don't know which sector. It looks like it's starting with an S. What is that? If we close that up, I can see that's energy. And then if I reopen this, I can move on to the next one. And that was another S, and that's because the S&P 500. If I close that, I can see that that's materials. And if I open that up, anyway, you can see that's kind of headache. Here's a quick way to see which, now symbols do not always align with the thing that's being charted, right? What's the symbol for Salesforce as an example? CRM. Where do you come up with that? What's the symbol for Broadcom? AVGO. Symbols don't always align with what the charted stock or index is. And with these, we can't really guess it from the symbols unless you really memorize these. So here's a little technique. I'm going to click on little gear here to customize our list, our columns. So let's choose customize. And let's say that our trader doesn't really care about the market capitalization of the different sectors. Maybe they don't even care about the current value of the sector, but instead they would like to see a description of that sector. Let's type in description, add that as our sole column next to the symbol, and click OK. And now you can see at a glance, we can see what these sectors are. And then the trader can walk down through this and let's see. So we had votes for real estate, financials, consumer discretionary, information technology, healthcare. So I'm going to click on energy. How's that been doing? Kind of flat over the last several months. How about materials? Coming down off of recent highs. Let's give it some credit. How about industrials? This is actually trading at all-time highs. Well, not necessarily all-time highs. I'm only seeing 12 months here. But how do we know which ones are actually the strongest that have been contributing the most to the advancement of the S&P 500? One more tool, if you don't mind. I'm going to throw you one more tool. So we've learned about the seasonality chart. We've retrieved the S&P 500 sector indices watch list. I'm going to load up here a chart called relative strength. It's just going to show which of these sectors are relatively stronger than the other ones as compared to the S&P 500. So it's one of our technical indicators. So I'm going to come up here to our Flask icon that gives us access to our indicators. And I'm going to type in relative strength, not relative strength, relative strength. Anyway, let's choose that from our list of studies. Add that to our chart. And you'll notice it says relative strength, and then it has SPX. That's the symbol for the S&P 500. It's going to be comparing our sector to the S&P. And it's going to show the relative performance of one versus the other as a line. So if I click apply down here, click OK, we get this line. What does it mean when the chart of our sector, in this case industrials, has been going up, but our line down here for relative strength is going down? It means that relatively speaking, despite recent growth in industrials, it's not as strong as the S&P 500. It's relatively weaker. That's the interpretation here. If this line is going down, then our charted symbol up here is weaker than the S&P. If this line is going up, so during this time frame, we might have said that industrials were stronger than the S&P 500. And yes, it's even possible to be stronger than the S&P when we're going down. Maybe we're just not going down as rapidly. Just like it's possible to be weaker than the S&P when we're going up. We're just not going up as rapidly as the S&P. So using this new tool, the trader might go through the rest of these sectors. It looks like it's been a dead heat for consumer discretionary in the S&P. Look at this run since April. That's been pretty much matching the run that the S&P has done since April. So we see this just going like that. All right. Hill says, how is this different from the RSI? Very different. Very different. Just have to say, I can't get deeply into the weeds of how the RSI is constructed and how the relative strength is constructed, but they can sound the same. We have the relative strength index, RSI, and then we have relative strength. Very different things. Okay. All right. So now before we go find maybe the sectors that have been the strongest, let me first of all, I'm gonna hit the pause button on the presentation and say a survey has just been added to the chats for the live stream audience. So if you're here in the live stream, do me a favor here, click on that survey link and then wait until after the webcast is over and fill that survey out if you would. A couple of things that you should know about that survey. Number one, it's a very short survey, 2 multiple choice questions, and it might be just done there. Click, click, and you're done. But also there's a comments box and a suggestion box. And I was just reading through the comments and suggestions and the data of the most recent survey just today. I read through all that stuff. It's never a wasted effort for you to fill out one of our webcast surveys. At least I can speak of that for me. If you fill it out, I'll take the time to read through it. So thank you for doing that. Eva, thanks for calling that out. But let's get back to the different sectors and let's see what's going on with Staples. Staples not having a great run. Now that doesn't mean that there's no opportunity here for some traders. They might actually be looking for exactly something like this. Maybe they're looking for a sector that's kind of fallen out of favor and they're looking for the first signs of life. Maybe that'll have a little more upside, a little bit less volatility than possibly a sector that has already been enjoying a great run and just looking for an excuse to reverse. That's a possibility. There can be different ways to view these things. So let's move on to healthcare. Healthcare is interesting. Healthcare was much weaker than the S&P 500. We see that expressed with the downward sloping relative strength. But for some relative strength users, they look for breaks of trend as a sign that that sector, and yes, this could be done for individual stocks. So maybe it was a stock when compared to the S&P, but maybe this is getting ready to move in a new direction. And kind of interesting, we had a break of our trend line right here in the middle of August, started to show some strength. Really, we've moved from weaker than the S&P to matching the S&P. That's an improvement. And if you'll notice, what has this sector done since about that time? Been a nice run. So maybe healthcare, for those that are looking for sectors that were out of favor but showing more recent signs of strength, this might be a way to spot that. What else? Financials, still struggling. Somebody said information technology. I know a few of you did. If I click on that, yep, look at that thing. Just rocketing to new highs, ahead of everyone else, strongly contributing to the performance of S&P 500. All of this may contribute to that trader who's trying to make it through current day situation, especially, maybe as we're looking forward to the holidays. We now have some perspective regarding what has historically happened. We now have some perspective regarding what's been happening among the different sectors. We might have some traders who are just looking for trading into strength. We might have others who are waiting for reversals. Lots of different ways that this might be used, if they use it at all. So now we're ready to move on to individual stocks. So let's clean this up. I wanted to show you a couple of those tools. Click apply and click OK and take off that relative strength. And with all of that as a backdrop, let's look at a couple of stocks. First one I wanted to look at was United Healthcare. This is one that we've looked at in other webcasts recently. This is, remember that healthcare sector is the one that had been underperforming, just recently showing signs of strength. And you can see maybe a reversal from lower highs and lower lows to higher highs and higher lows most recently, possibly breaking out of what we might call a triangle here on this earnings announcement. And just recently breaking above a previous price ceiling. I wasn't going to draw an oval, but an oval will work here. That'll make the point anyway. So this is in one of those sectors that seems to be turning. It also is at a time in the marketplace where there seems to be strength, at least on average over the last 20 years, for the next few weeks. Now, does all of that add up to guaranteed performance for United Health Group? Of course it doesn't. It could just sag right back, but in this case, we also have the benefit of an apparently positive reaction to an earnings announcement. Now we have another stock. This is the one that I'm going to trade today. Earnings, again, just in the rearview mirror. This is one of those companies that had been underperforming, but maybe just got a kick in the pants here. Positive reaction to earnings. I wonder, forgive me, I'm just going to explore something. This looks to me like about a 1/3 retracement of the move from this price floor. I wonder if I just throw on a Fibonacci here. Let me click on this. Right at the top, go down to the bottom. Yep. So I thought came right down to about that 61.8, starting to bounce. How about let's do a long call on Coca-Cola. Maybe, Coke used to run these great ads with the, wasn't it Coke that had the polar bears? Very Christmassy. Moving into the holidays. Anyway, let's say that our trader thinks that we've pulled down to recent lows, starting to bounce, getting some bullishness here. And maybe this bullish time of year will just give this otherwise already potentially bullish chart a little additional boost. Kevin, Greg, Will, yeah, it was this. This was the bears. So let's do a long call for this example trade. We'll just keep it straightforward. When we're bullish on a stock, there are lots of different strategies that an options trader might employ. Buying a long call, probably the one that most people relate to most readily as being bullish. Selling put is also bullish. Doing variations on those themes, we get really fancy and do multi-leg, but this is getting started with options. So let's stay with a single leg strategy with the plan to get in on the evidence of this recent pullback after this positive reaction to earnings, and we're starting to bounce higher again. Maybe our trader thinks we could go back up and challenge recent highs. Where would that be? That's going to be up here around 73.5. Right there. Could be some resistance along the way. Now, it's also possible that our stock doesn't cooperate and it starts to go back down. And in that case, maybe we'll have a plan to take losses on our long call too. So let's go place our trade. Let's just round this off. Let's say 73.5. Let's go place our trade. And I'm going to put in in order to take out this position if we're able to get up to 73.5. But we're also going to put in a stop, let's say at half of the invested amount in this long call, just as an example. Mary Burns says, no concern regarding the fill in the gap. So here's what Mary's talking about. For some traders, it's not an uncommon assumption at all that when we get a gap to the upside, if we break down into that gap, that's an initial qualifier. If we break back down into that gap, as we did here on the 23rd, there may be an assumption that we're about to do what we call fill the gap, go right back down to the bottom of the gap. Well, this one started to do that and then decided not to. Interestingly enough here, Mary, we've gone back up. We're back above the top side of that gap again. So kind of is already an assumption that has already failed from that sort of vantage point. Okay. What I will say though about this is that sometimes we hear a phrase, all gaps fill. It's not true. Nope. General Electric has been in business for 100 years. There are gaps along the way that never filled. Where the stock was moving higher, maybe had a gap and ran up for another couple of decades. That's just as an example. Upside gaps do not always fill. Downside gaps just depends. If the stock ever recovers, it'll fill. If the stock goes bankrupt, that one won't fill. There is a gap right here. Look at this. This is interesting. We gapped up, never even challenged it. The top side of that gap just acted as a nice support all the way through the rest of the year. It's not the reason, but just a technical observation that might be made. All right, but let's place our trade. A plan to take profits up there at 73.5. And whichever contract we buy, how about just for today's example, we'll put it in order. I'll show how to place an order to get us out if the value of our investment drops by half. Now, that sounds crazy to a stock trader to say, wait a minute, I'm going to wait for my investment to lose half its value before I pull the plug. Stocks and options are very different things. Options, highly leveraged. Stocks, not leveraged. So, we might use larger percentages than the trader is otherwise used to in order to accommodate for the inherent volatility of options. So let's go to our trade tab. Oh, wait, one more thing I ought to do is how long do we think it might take to get up to 73.5? That's an important question. Now, if it rockets straight up, could be there in a few days, I guess. But at its current rate of ascent, all right, we're not going to have another earnings announcement to give us a boost like this. Let's say that our trader thinks it's going to take at least a month if it ever gets there. That's an important decision because if they don't want to run out of time, maybe they buy more time than that on the contract. And a common rule of thumb is that however much time we think we need, we double it. So if we think it's going to take a month, how about we go buy a 2-month contract? Let's go to our trade tab. Let's go to our option chain down here. 2 months out, well, there's a contract that expires in 52 days. That might not be enough time. There's a contract that expires in 80 days. That may be sufficient time, but it's a little bit more than maybe we were planning to buy. It's going to be a little bit more expensive. Let's see. Mary Burns says, do you need to do anything with that 50% to avoid the morning crush stopping you out? So Mary's asking about the volatility that can be typical in the early hours of trading. I think that's what you're saying there, Mary. By the way, I just had a pop-up on my end. Do me a favor here. If you're hearing me chat in, let me know if you are having any issues with my audio. In any case, getting stopped out. Okay. But going back to Mary's question there, in the early hours of trading, there can be volatility. And an adjustment there for a trader might just be if they were planning to use a 50% stop, they use a higher percentage, 60%, 70%, if their stock is particularly volatile. Might not be necessary. But that's also where a little bit of manual oversight might come into play or help out. In any case, let's go to these 80-day contracts. Another thing that the trader has to decide now is which strike price to choose. We can go in the money. Those contracts are pricier, but they also, there are pros and cons to going in the money. Number one, we have the right to buy the shares at a lower price. That's a potential pro. Number two, there tends to be less time decay on these contracts. Number three is that, for better or for worse, there's less leverage on these in the money contracts. Now, if we reverse that and we go out of the money, the contracts are less expensive. That's a pro. The cons are it gives the trader the right to buy shares for a higher price. There is more time decay, but also, for better or for worse, these are more leveraged contracts. They go up and down on percentage terms faster. So if a trader is trying to amplify leverage or minimize cost or a combination of those two, they might go out of the money. If they're trying to minimize leverage. They don't mind spending a little bit more money, but also minimize time decay. Maybe they go deeper in the money. All right. Thanks for the confirmation there. Audio is solid once again. Perfect. Excellent. All right. But how about for our trader here? Let's say we're going to go with a stock trading around 70. What if we just buy the $70 call? That looks like that's going to cost us between $2.39 and $2.40 to maybe $2.40 per share, $240 for the right to buy 100 shares of Coke for $70 per share. And we're going to look to sell that right if we can get up here to 73.5. But if the stock starts to misbehave, if it's not going up and time decay is chewing away at the value of this contract, let's say that we just draw the line in the sand at half of that invested value, $1.20 per share is where we're going to draw the line there. So let's click on the ask price and now decide how many contracts we want to buy. I'm going to leave it right there at the natural, basically offering to pay current market price. I'm going to lock that though. Click on the little lock. That's literally telling the system, I don't want to pay more than $242. Trying to define the investment amount here. So if I pay $242 per share on one contract, that'd be $242. Let's say that our trader here is okay with investing and risking $2,400. So I'm going to leave it at 10 contracts. 10 contracts at $2.42 per share is going to be $2,420. But let's put in our exit orders. So I'm going to come down here where it has a single order queued up, which is just placing the one entry order. Let's change that to a first triggers OCO order. This is going to allow us to put in, as we right click and create an opposite order. This one will be our target. Right click and create an opposite order. This sell order will be our stop. So our target, we had decided we were going to make this a contingent order on price. Let's come over here to the condition icon, the little gear all the way to the far right. And we're going to sell our call at a future market price. We don't know when, but that would be if, this is the condition, if Coke market value is greater than or equal to $73.50. Go. Let's save that. And then our stop the bleeding on this trade if it's going the wrong direction. We'll make that good till canceled at half of our invested amount. That would be actually $1.21. I have to see if we can get this for $1 or for $2.42. So those are our two exits. Sell for whatever the market value is for this call if the stock price gets up to 73.5, or stop the bleeding at 121. With that stop order, it's not a guarantee that we're going to sell at exactly 121. But in any case, buying 10 contracts of the 16th of January $70 call for $242. We're going to look to sell those at the market price. Did I put in below? Look, that's why you always read. I need to go back to elementary school. Which way does the alligator mouth face, Cameron? Anyway, give me some construction paper so I can write this down. Anyway, we need to change that to at or above, right? So let's edit that. This. Let's change our trigger, of course, to the alligator mouth chomping on the market price being above 73.5. Yeah. When you're trading, a very healthy habit is to make sure that you read out that confirmation screen out loud. I've placed tens of thousands of trades for other people in another life, in another role earlier in my career. I did lots of trading for other people for another firm. Never made a mistake because I had to read that confirmation screen out loud. Now, at home, in the privacy of my home, where I'm dealing with the kids, talking with my wife, thinking about dinner, placing trades, I'm totally in my comfort zone. That's where I make mistakes. So you got to read these out loud. Let me click save here. Let's do that again. Confirm and send. Okay, we're going to sell those If, oh yeah, the market price is at or above 73.50 with a stop at 121. Now, due to potentially wide markets or liquidity risks at the time of activation of the stop, this order may be manually substituted with a limit order upon activation and worked until filled. And as we know, stops are not a guarantee of a specific execution price. There are commissions on these trades to get into or out of these trades, but I'm going to send this order off. We'll see if we get it filled. There we go. We'll let that work. What is it looking like? 242. We're right there. 242 is what we're offering to pay. 242 and a half. We got it okay for 241. All right, guys, but we have done it. When I launched this webcast, I wanted to talk about trading through the holidays and what tools might support that effort. So we got acquainted actually with a good handful of tools: the seasonality tool, the sector indices watch list, the relative strength tool, and then of course just planning and placing a trade using a stock chart. So hope that was useful for you. This is what we do on our Tuesdays. We talk about concepts related to getting started with options. If you need to go back and revisit the logic of anything that we've done today, watch for the recording for this session, which is a good reminder. If you are new to this, to our webcasts, make sure, first of all, that you've subscribed to our Trader Talks channel. You can go down and click on the subscribe button. That only takes a second. It doesn't cost anything. But our Trader Talks Schwab Coaching Webcasts YouTube channel is where you can join our live streams. You can also find our playlist right there. Now, Kevin has done a fabulous job. Thanks for reposting that survey, Kevin. Everybody, fill out that survey if you would. But Kevin and I also would like to give you an invitation to follow us on X. You can find Kevin on X at Kevin Horner CS. You can find me there at Cameron May CS. But this is where I just post observations about the markets. I tell you about my weekend. And if you reply to one of my posts, I do make my best effort to reply back to you. So, for example, I posted about Amazon's announcement today. Had a great day for employees at Amazon in some roles. But also, make sure that you are following Ben Watson and me on LinkedIn. You can now follow us there. Let me go there. Here's LinkedIn. There's my profile. A little bit different looking guy there, a little bit older. Same Scottish castle in the background, though. Just 67. What do we call these on LinkedIn now? I'm brand new to LinkedIn. So what do we call these, connections? Anyway, yeah, connect with me on LinkedIn. But here's where I'm going to be doing a little bit more in-depth posts. I don't have that character limitation that we have on X. So yeah, I might be able to provide a little bit more observations, insight. In any case, give me a follow there. Do it on both platforms. I think that'd be great. But guys, I will let you go enjoy the rest of your day. Go watch the rest of our webcasts if they appeal to you. I'll look for you in a future webcast of mine. I'll also look for you on X, and I'll look for you on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.